$1 million on the line. Warren Buffett versus a hedge fund. What's the bet? Warren believes the S&P 500 index, otherwise known as the market average, will outperform a hand-picked portfolio by the hedge fund over a 10-year period. Why would Warren Buffett place this kind of bet? I mean, it's pretty risky, right? There's $1 million on the line. The answer is, it's not really that risky because the odds are severely in his favor. Believe it or not, more than 86% of financial advisors or hedge funds cannot beat the market over a long period of time. One big reason for that is because picking individual stocks like most financial advisors and hedge funds do, there's more risk because there's less diversification, meaning while there may be more upside to the stock, there's also just as much downside. And over a long period of time, it's very, very difficult to pick a handful of winners. I mean, if all investors had the same market information, it would be impossible to know which holdings will perform the best over time. You're pretty much just guessing. There's no crystal ball, and if there were, more people would be millionaires. Knowing this, Warren placed his bet, and the results were pretty shocking. Warren placed this bet against the hedge fund in 2007. 9 years later, the cumulative returns of the hedge fund were 22%, while the S&P 500 index returned a massive 85.4%. That's almost 4 times the amount of returns compared to the hedge fund. So clearly, Warren Buffett won that $1 million, and he actually donated it to charity. The reason I told you that story is because it's a perfect representation of something that I want to dive a bit deeper on. And that is, does it make sense to pay somebody like a financial advisor to manage your money when their returns most likely won't even beat the market? Most financial advisors will charge a fee to manage your money. Typically, it's between 1% and 2%. Now, my honest answer to this question is no, because you are leaving too much money on the table over a long period of time. Take a look at this financial model that I created. This shows the returns if you invested on your own in a benchmark ETF like VTI from Vanguard, or if you went with an advisor and paid a 1% fee. This assumes you have an initial investment of $10,000 with annual contributions of $6,000 or $500 per month. The annual return rate is going to be around 7% after being adjusted for inflation, because that's typically what the market is. I should also mention that holding an ETF like VTI from Vanguard does come with a small cost. In this case, it's 0.03%, which of course is significantly less than 1%. Beginning with the financial advisor, they charge a fee of 1%, so your annual return is going to be 6% after it's all said and done. And that's if they follow the market. And at the end of 30 years, you are going to be left with over $531,000. That's not too bad, right? At the end of the day, you still made money, but ultimately not as much as you could have made. Looking at the market ETF, the amount over the same time is more than $639,000. That's a $107,000 difference just from that 1% fee. And once again, this is assuming the financial advisor follows the market average. And as research indicates, the odds are they won't. And even if they follow the market, you still are behind by 1% because that's their fee. So to make investing worth it with a financial advisor, they would need to return above the market by 1% just for you to get even with the market. They would need to return 8%, they take out their 1% fee, and you're left with 7%. The method that I prefer is using a free investing platform like M1 Finance, Webull, or Robinhood, and picking a benchmark ETF like Vanguard's VTI, and that's going to follow the market for a 0.03% annual fee. Now, yes, you are still paying a very, very small fee, but compared to 1%, that is very huge. And as you can see, in the long run, over a 30-year period, the difference from just that 1% is going to be over $107,000. Overall, the results from advisors tend to be lackluster and more expensive when compared to the market. Now, I don't want to take anything away from financial advisors or professionals because at the end of the day, you most likely are going to make money. But this is a story about opportunity cost. Yes, while financial advisors can still make you money, you have to think about what option you are giving up. In this case, you're trading a 1% annual fee for a 0.03% annual fee. And odds are you're going to perform better with the lower cost. Advisors are still great because they can provide good information on what you can do with your money. And this is especially true if you're a new investor or you're not really comfortable investing yourself. Personally, I think using a free investment platform and buying a low-cost ETF like VTI, for example, is a great way to keep pace with the market. For myself, I use M1 Finance, but there are many other great investment platforms out there where you can pick up any ETF for a very low cost. And this is what I recommend when compared to a traditional financial advisor. Those fees are really going to eat up your returns over time. I think the Warren Buffett story brought out a really good point that hedge funds and financial advisors tend to underperform the market. And I wanted to take this a step further by showing that if you invest with a financial advisor and they follow the market, your opportunity cost over a long period of time really adds up, potentially hundreds of thousands of dollars down the road. That's going to wrap up the video. I hope the information was very insightful, and I hope it really got you to think about investing. At the end of the day, I just want to give you guys the information to do your own research and decide what makes sense for you. Had I not taken any courses or done my research about finance, I never would have known about this information, and it could have cost me hundreds of thousands of dollars down the road, and that's something that I don't want. So I want to give you guys those tools as well. Thank you so much for watching. I appreciate each and every one of you. Good luck investing.